We're looking at the distribution of income, and we looked through an activity or a previous class on how income is distributed throughout the world, and how it seems that in many countries the wealthier are getting wealthier and the middle class and the poor are getting less in terms of income distribution and equality. So they're getting a smaller proportion of national income, whereas the wealthy in many countries, particularly the top 1%, have become more concentrated in the percentage of national income. So we're looking at now what governments can do to arrive at a more equal distribution of income than what would be achieved if the free market was left to its own devices. So before we start, just a distinction between income and wealth. So wealth is what you own. So you can think of houses, a house, a car, appliances, jewelry, etc. Can cash become wealth? Yes, if you've paid your bills and it's left over afterwards, then money in the bank certainly can become wealth. And can you have negative wealth? Certainly. So if you are in debt. So you owe more than your assets are worth. Income is more like a money flow. We have salaries, we have bonuses, we have dividends, which is the profit from firms. If they decide to pay it back to the shareholders, they'll send them a check known as a dividend, etc. Questions to ponder. Can you have a high income and no wealth? Well, if you're spending everything that you're earning, certainly. Can you have a low income and still have some wealth? Yes, particularly an example of, let's say you've come into an inheritance and you are either not working or working at something that's not paying a tremendous amount. So what you own is often referred to as your assets. And some major assets for consumers, we've looked at them on the previous slide, but the biggest one is a house, generally followed by a car. And what are some major forms of debt for consumers? Well, for a house, you may have a mortgage. You may have student loans. That's been in the news a lot upon graduation. You might have credit card debt. Which is increasingly becoming a problem in North America. And if you have high forms of indebtedness, then that, of course, takes away from the consumer's ability to be able to consume and buy things. The Occupy movement, many of you have heard about, where the top 1% owns a disproportionately large percentage of national income and wealth. And those who are not in the 1% are referring to themselves as we are the 99%. The top 10% and 1% of earners, we looked at this in class, that the top percentage, particularly the top 1%, have increasingly been getting a larger and larger share of national income. And the concentration of income amongst the super rich is happening in many countries, including Canada. The market-determined distribution of income in the economy is likely to be very unequal, with some people receiving far larger shares than others. So why is this so? Oh, we might have differing skill sets. You might have people with connections. So particularly the wealthier you are, you might have political connections or connections in the business world, differing levels of education. Can also be geographical. If you live, for instance, in the far north in Canada, there's far fewer opportunities than if you're living in one of the major cities, and etc. So methods that can be used to redistribute income and output. One of them is known as transfer payments. And in essence, what a transfer payment is it's payment without the expectation of receiving any goods or services in return. So they're called transfer payments because they transfer income from those who work and pay taxes towards those who cannot work and need assistance. So what are some examples? Things like old age pensions, disability pensions, unemployment benefits, child allowances, housing benefits for the poor, students' grants, and so on. So in each of these cases, no expectation that goods or services will be provided for these transfer payments. We looked at subsidizing merit goods, and they're considered to be beneficial, generally beneficial for consumers, but are underprovided by the market. And we know that they have positive externalities, and also consumers often are unaware of the desirability. So I think of something like the flu shot that's often provided by the government, because individuals may not realize the importance to society of something like a flu shot. So in most countries, we know that these merit goods include education and healthcare, but in developing countries, they can include something as basic as clean water supply, sanitation, and sewage. And these are often subsidized by the government to make them affordable to the very poor. Government intervention in markets we've seen in micro, things like minimum wage, price supports for farmers setting a legal minimum price above the market equilibrium price, and subsidies to producers, whether they be agricultural or certain industries. And taxation. We're going to focus a fair bit on taxation in this and then continue to look at actual concrete examples for higher level. So taxation. We can lower income inequalities by taking more taxes from the rich than from the poor. And we'll look at the different kinds of taxation. In the US, the poorest fifth of the population pay only about 4.5% of their income in federal taxes. Now let me just explain how income taxes work. In the States, you have federal taxes and state taxes, and they'll be combined into a higher tax rate than this, but we're just looking at federal taxes. In Canada, we would have federal and provincial taxes added together. So to continue, the middle fifth pays just under 14%, and the top fifth pays about 25%. So of course this would be higher once you add in the state tax. At the very top, there are even higher tax rates, with the richest 1% paying just over 31% of its income to the federal government. So we can see that as you earn more money, you're paying a higher percentage of your income in taxes, and we'll see that this is called progressive taxation. So you might wonder then, Mr. Buffett is very, very wealthy, why he only pays 17.7%. Well, his income is made from investing in stocks and bonds, and most of his income is made from dividends and capital gains, and they're taxed at a lower rate, in this case 15%. So Mr. Buffett does not go out, work for someone else, and then get a salary paid to him every month. His is on investments and investing in the market. Now, the reason why the government wants to tax that less is that they want to promote investment, and they want people to set up companies. And just to give you an example of a capital gain in the context of a company, if you were to set up a company for, let's say, $2 million and sell it for $5 million a few years later, then you would be paying capital gains on that growth of the company, which would be $3 million. The same thing happens for stocks. If you buy a stock at one price and then sell it at a higher price, that difference is known as a capital gain. So this is not the same thing as income when you go to work for someone else, and the government wants to promote this kind of activity. So, question, why do you not want corporate and income tax rates to be too high? Well, if they're particularly high, you might have corporations leaving your country, setting up elsewhere. You might have people leaving and living elsewhere. Or you might have individuals deciding not to work so hard because the tax rates are so high and so much is going to the government. Now, this was more in the news about a year ago, but there's something called tax inversion that we saw in the States, where Burger King merged with Tim Hortons. Tim Hortons' head office was in Canada, and with Burger King merging with a Canadian firm, they were able to say that they've moved their operations to Canada and be taxed at a lower rate. Now, what's interesting is that you may think, oh, the taxes in Canada are much higher than elsewhere. Not for corporate taxes. They are actually amongst the lowest, if not the lowest, in all of the OECD countries, the Organization for Economic Cooperation and Development, OECD. So this happened in the case of Burger King and Tim Hortons, which upset the American government quite a bit. So none of these calculations say whether the rich are paying their fair share. Fairness is a normative concept. We could be having a discussion where your interpretation of fair is very different from mine. So we're not particularly at this point looking in terms of what is deemed to be fair. But with that still said, albeit this is dated, but it is a Canadian statistic, we had the top 5% of income earners paying almost 40% of taxes in terms of personal taxes. So that really is quite considerable. So you often hear the rich have so many loopholes and so on and so forth, but in reality they are paying quite a bit of the taxes. The role of taxation in income redistribution. So taxes can be used to redistribute income from the wealthy to the poorer, but taxes are used for many other things. So please don't think it's just for income redistribution. They're used for things like providing public goods, transfer payments, merit goods, correcting negative externalities, providing subsidies, changing the allocation of resources, limiting the quantity of imported goods, pursuing a variety of different fiscal policies, and changing the distribution of income. So the role of taxation is much more varied than just income redistribution. So please note the difference between direct and indirect taxes. Direct taxes are paid directly to the government. Please do not use that as a definition. This is just the mechanism to which how the tax reaches the government. What you want to focus on for direct taxes is that they are taxes on income. They are taxes on personal income, on corporate income, and wealth taxes. Indirect taxes, again, as a mechanism to get to the government, they go through a third party. So if you go to the store, you pay the retailer the tax, he or she collects it and then forwards it on to the government. That is not the definition of indirect taxes. Indirect taxes are simply taxes on the spending of goods and services. So you can have general expenditure taxes, such as a sales tax. Here we call it the HST, which I believe is 13%. In Britain, it's VAT tax, VAT. And some goods are exempt on the grounds of equity, so food, pharmaceuticals, rent, etc. It's felt that to tax the poor on necessities is not really equitable. Now, excise taxes, please don't confuse this with export taxes. Excise taxes are taxes on specific goods and services, such as cigarettes and gasoline. So if you go to fill up the car at the gas station, you'll see how what the tax breakdown is. It's usually listed on the pump, and I believe it's something like 14.7 cents for every liter goes to the federal government. So that would be an excise tax. It's targeting a specific good and it's a specific tax rate. And then we'll be looking at this in grade 12, but customs duties, such as taxes, tariffs, which are taxes on imports. The ability to pay principle. Taxes should be levied on individuals or households according to their ability to pay a tax, or in accordance with their income or wealth. If it's not, you're going to run into a number of problems. People will either start to cheat, start to pay cash under the table, or they may stop buying goods, or they might go across the border and shop in Buffalo, and so on. So you can't tax to any sort of limit without taking this into account. So proportional, progressive, and regressive taxation. This is according to the relationship between the income and the fraction of income paid as tax. Now, it's really important that you look at it as a percentage of income or fraction of income paid. And this fraction of income paid as a tax is referred to as the tax rate. And we'll look at these three kinds of taxes. So proportional taxation. As income increases, the fraction of income paid as taxes remains constant. So there is a constant tax rate. Now, I don't know if this is still the case, but Hong Kong used to have a 15% flat tax. So whether you earned a lot of money or whether you earned a little, as a percentage of income paid as tax, it remained constant at 15%, and everyone paid that regardless if they were low income or high income. Progressive taxation. This is what we see with our income tax in Canada and the States and Europe. As income increases, the fraction of income paid as taxes increases. And so we say that there's an increasing tax rate. And regressive taxation. As income increases, the fraction of income paid as taxes decreases. So there's a decreasing tax rate. You may be surprised to know that we do have regressive taxes in Canada and the States. We'll look into this in the next slide or so. So what kind of tax is a Canadian income tax? Well, it is progressive. So we have low income earners. Pay a smaller percentage of income in tax, and high income earners pay a larger percentage of income in tax. Okay, so let's look at HST. So 13% on goods and services. Students will often say, well, that's proportional. It's the same for everyone. But you have to remember that it is as a percentage of income. So let's look at an example. Low income and a high income consumer buy a $20,000 car with, let's say, $5,000 tax. So for the low income consumer, the tax is a high percentage of income. And for the high income consumer, let's say they're earning $200,000, the tax is a low percentage of income. So in fact, this is regressive. Now, you may be pleased to know that when you get into university and you have a job over the summer for 4 months, and maybe you've managed to earn something like $10,000, and you go and file your taxes, the government will deem you to be low income. They don't take into account that you're a university student and so on and so forth. They just have seen that you've earned $10,000 for the whole year. So what will happen in the fall is that you'll get a nice surprise of a rebate check to offset the HST, and it could be worth several $100s. So you probably won't be expecting it, and there it is, and it arrives. So this is the government's way to low-income consumers to help offset the fact that this is a regressive tax. I've also come across articles where they talk about tariffs, which are taxes on imports, as being very regressive and really hitting the low-income consumers much more than other consumers. And so to keep that in mind when imposing tariffs, that they are regressive. the 10-chair activity we did to show the distribution of income in Canada. So the Gini coefficient, it's an inequality indicator, and it's an indicator that we can use to compare from country to country. It varies from 0, which indicates perfect equality with every household earning exactly the same, to 1, which implies absolute inequality with a single household, earning a country's entire income. Latin America is the world's most unequal region with a Gini coefficient of around 0.5, and in rich countries the figure is closer to 0.3. It was interesting to note that Sweden was the most equal of income distribution in the world. Now you may see, if you're looking this up on the internet, that instead of it ranging between 0 and 1, they might have it range between 0 and 100, but you can easily convert that to a 0 to 1 scale. So how is it measured? Well, you can have this mentioned up here, or you can bring that and put it down here in terms of labeling the axes. With a little sort of reminder, any graph with economics tends to have anything to do with money or income on the y-axis. So we've got the cumulative percentage of income on the y-axis and cumulative percentage of earners on the x-axis. This straight line here is the line of perfect income equality. So this is where every household is earning exactly the same amount of money. And the bowed out line, which I sort of refer to as a banana, but don't do that on a test, okay, is the Lorenz curve. This is the actual distribution for a household. For a country. So let me just back this up. In the line of perfect income equality, if we looked at the bottom 20% of households, they're earning 20% of national income. If we look at the bottom 60% of households, they're earning 60% of national income. So everyone's earning the same. As the line bows out further and further, the income distribution is becoming more and more unequal. How you end up coming up with the Gini coefficient is they take the distance between these two lines. So if you were in calculus, don't worry, you won't be asked to do this at this level in economics, but you would estimate the area under the curve and then divide it by the area under the line of perfect income equality, meaning this large triangle. Now, I'm not going to go over to the next slide yet. I'm going to pick up the information they're asking you, but they ask you to read from this Lorenz curve, what the bottom 20% of households are earning. So that would be here. And in terms of what they're earning roughly 9%. Then they ask you to estimate what is the top 20% of households earning. And again, this is divided just like our chair activity into quintiles, so 1/5, so hence 20%. Well, to find the top 20, we really need to look at the bottom 80% of households. The bottom 80% of households, if we bring that across, is earning 60% of national income. Well, if the bottom 80 are earning 60%, then ergo, the top 20 must be earning 40%. So here we go. We had the bottom 20% of about 9%, the top 20 being 40%. And how we managed to calculate that top 40 is to look at the bottom 80 earning 60%, and so therefore the top 20 must earn the 40%. So there's a description of how you come up with the Gini coefficient, and yes, I have actually seen them ask on an IB exam, particularly a paper 3, to explain how you come up with the Gini coefficient, although I suppose that could also appear in a data analysis in a part C. Income inequality, I showed the one slide of Chile where we've got lovely condos, beautiful balconies, gorgeous tennis courts, a lovely swimming pool, and then a concrete wall with slums on the other side. Well, students had also commented that they'd seen the same happen in Brazil and the same in Argentina. So obviously this is not unique just to Chile. The Laffer curve, this is the last concept we're going to look at. Look at on the x-axis the tax size, and on the y-axis the tax revenue, once again to do with money. Okay. We can see as we tax more, it makes sense that our tax revenue is going to increase. But there will be a maximum that if we continue to tax, the tax revenue is actually going to start to decrease. So if we look at it in terms of income tax, and we'll look at an example with the Beatles from many years ago, if you continue to tax horrendously, so in the case of the Beatles, their marginal tax rate on their top earnings was 95%. You can have people move. So I believe the Beatles moved from Great Britain, so did the Rolling Stones. More recently, Gérard Depardieu, the actor, moved from France to property in Russia. You can have this exodus. Or you can simply have people saying, I'm not going to work so hard. I don't want to be giving the government all this money. I'd rather go golfing or spend time with my family, and so on. And the term in the case of a tax on goods and services, so an indirect tax, you might have people starting to buy things in other countries. So in the case of Canada, they go to Buffalo to shop, or other places. You may have people doing cash deals where it's not being captured, the transaction's not being captured and tax is not being charged. Or you may have people just reducing their consumption because of the high level of tax. So I'll let you read that on your own. You can pause the PowerPoint. And The Taxman, it was written by George Harrison in the 1966 album Revolver, and it attacked the high levels of progressive tax by the British Labour government of Harold Wilson. So the top tax bracket, it was a super tax of 95%. And the lyrics in the song go, there's 1 for you, 19 for me, meaning the tax man. So you keep $1 and I'll keep 19, which would be, I guess, the ratio of 5 to 95, or 5% to 95%. Anyway, thank you.